Hello traders, welcome to FreeFX. I'm Francesco. Today is the end of a trading week, so the US market is now closed, and so I just wanted to talk a little bit about what the week has been like, especially today. Let me go straight to the charts. First of all, thanks very much for all who joined me and for comments on the channel. Really appreciate it because I do this in my own time. So obviously it's very good to have comments and positive feedback. So, but this is the SPX, which is the trade. As you know, there's the SPY and there's the SPX. The SPY is an ETF and the SPX is options based. But I trade it, as I said, through under. So it's kind of like a kind of 24-hour contract. So through the day, obviously we've seen a lot of price action. This is the daily you're looking at now, and you can see that yesterday's candle was a perfect doji right there, and you can see that it's been a very tight day today as well, but there's been a little bit of a move to the downside, and really just looking at that doesn't really give you a sense of the intraday action. So if I go to a smaller time frame like the hourly, you'll see that there's quite a big move here, and this was the during the European session before the US session, and 1 p.m. UK time. So right into the non-farm payroll, and the release for that was obviously very positive. So now different ways to interpret this, but the result was a very steep candle. Very interesting was that subsequently with the next candle, sort of half of that move was retraced. And then through the day, sort of 3/4 of that move was retraced. However, it does remain a mystery as to what what the non-farm payrolls actually means to money being moved in or out. What sort of short-term, very short-term bullish. But it's very obviously choppy like this. So it's really hard to say that this means anything in and of itself. So if I actually went to the daily again, just to show you what the context is in a technical sense. So technical analysis is still important even in this context where the kind of general sentiment is a bit wavering. And I just kind of highlighted these 3 points because I was looking at John Bollinger and his kind of use of the Bollinger Bands and the way that we can use them sometimes. So just like with trend lines, you tend to have this sort of relationship between momentum and price. So price here is moving higher, but the 3 instances that I've highlighted there with these circles are actually also then checked against an indicator that's a kind of oscillator, and the CCI is showing these 3 instances with price not actually agreeing in the same way. So if you look at, just get rid of this, if you look at this movement in the CCI, so I got it set it up as a 200 positive. So the this sort of solid pink line is the 200. So when we approach 200 on the daily, it's usually quite an extreme thing. So I put something on Twitter recently, I think earlier today, actually, and saying that there have been 2 instances of this. 200 was actually instrumental in the January move when we got to here. You can see it's just the end of December. We touched near the 200, and then we had basically a move down. The second time was here in March, and you can see that there was a bit of a flat period, and then price kept moving higher, but the CCI actually didn't. So there was divergence there, here, and there, and then eventually that started the January downtrend, which really retraced in one move almost down deep into this territory, which is the negative 200. So that was a kind of like straight move down on the CCI, and then price really was quite strongly down through the weeks. So with that said, so this filter of a 200 positive, in this instance, we just arrived at that. So let's make it a bit bigger again, and you can see that we've arrived at it by degrees. So first we were like between the 0 and sorry, at the 100, then closer to 200, and then just the end of July, start of August, we got to the 200. Since we've actually touched the 200 proper, you can see the price is kind of wavered a bit. It crept higher through this week, but the CCI has actually had negative divergence. So the CCI has kind of lost the will to live, essentially. Now, 3 usually is not a magic number, so this may go on longer, but there is kind of really a strong resistance up here, which is the monthly time frame 20 SMA. So there is potential that this is technically actually confirming that this sort of bear market rally up move has kind of run its course. So if I show you on the monthly, that level that I put in there is the simple moving average, and that's the, you can see the orange there is your simple moving average, and we're just on that level there. So this month has been basically just a tiny candle right beneath that, and it's not really been able to make much progress. So that's the kind of wider perspective. It's kind of where we are. And then we look at, so the non-farm payrolls today was quite strong. And then so the interpretation of that is, well, you know, if the Fed is worried about jobs and employment, it has this dual mandate of unemployment and inflation. So it's trying to fight inflation with the hikes, but then we are technically in a sort of recession, 2 negative quarters of contraction in GDP. And therefore, if the jobs that come out unfavorably, then the sort of the market interpretation of that is the Fed may obviously have to respond by maybe rethinking on the hoof, or literally sort of as the data comes out, although it's the previous month's data, and maybe just cool down the sort of the pace of the hikes or the amount of increases per hike. So that sort of speaks to, you know, positive jobs. The Fed is confident that it can continue with this kind of soft landing. So, you know, fighting inflation by raising the central funds rate, and that way is not worried about causing a recession. So that means, you know, no sign of slowing down. All the speeches we had this week from the Fed, some of the Fed members, Kashkari, we've had Daly, we've had, I think, Brainard, and we've had several saying that no, actually we see the target being even higher than 3.5 up to 4%, and so, you know, it doesn't sound like the Fed is really, and also the Fed Watch tool has actually made the 75% rate hike is going to be potentially a high percentage now of probability for the September meet, which is obviously the next one. So I'll just show you the next meet in September. There it is. So our current target rate is 225, 250, and the 300 to 325. That would take us to 75 basis points. Has gone up to 77.5%. So only start this week that was a much lower number. Can't remember what it was exactly. I think it was in the 30s or something. It's gone up to 60s and now it's 70. So clearly that 75 basis points that seemed a bit unlikely is definitely going to be on. So I'm going to close that. So that's the scenario of bullish sort of NFPs, bearish markets. The mystery is that August is meant to be a more volatile month and bad for stocks generally. So and we've seen things like the Tesla stock coming down. So if I just did I don't know if I should do a comparison now. Let's do a Tesla comparison there. If I can TSLA, there's a Tesla on the Nasdaq. If I just do a separate price scale, I haven't looked at this, so I don't know what I'm going to get. And put it down to daily. Let's see what happens. I think I heard that it was being sold a lot today. So, well, there it is. There, that's the Tesla stock. So we've had earnings, we've had everything, and it's kept rising, keeping pace with the indices. But big sell-off today. If I just go to the hourly, just to really get a sense of how that looked. There it is. Right. So there was a big sell-off there. So, and it's not really done much through the day except selling. So individual, so Tesla is obviously a big component of the S&P. If you're ever looking for the market cap components of the S&P, which is cap weighted, so obviously it's the capital size of each company that creates the weight on the index. You can go to something like SP 500 market cap components. I think that will give you there's, I think this one, Slick Charts, I was looking at the other day. I was checking exactly that, and you can see the weight. So the top one is Apple, followed by Microsoft, Amazon, Tesla is the fourth. You know, it's a big influence on the index. So the context is that possibly bearish the market. People talk about the kind of short squeeze, so this sort of rallies for suckers and all this. But let's kind of go to the futures for a moment, because I just wanted to show you something that I prepared here. Now you'll see this thing, which is a symmetrical triangle. Now, so this is the hourly view of the E-mini futures September expiry contract, and you can see volume on the hourly on the day, strong volume, but we've had stronger volumes really. It's not been a super day, and there's not really been much movement out of the day's range, as you can see. That's why we've got a small candle on a daily. The symmetrical triangle that we've had today, so started, let's just move forward a little bit. Let's say that it's kind of here. Now the symmetrical triangle is, if you're not familiar with chart patterns, I need to sort of refer you to the pattern site. Okay, the pattern site is a really good resource, and if you've not seen it before, I urge you to go to it. And the founder is an amazing person. Bulkovsky started this many years ago. So if you just check out the history of this, it will tell you that he's also published a book, obviously, and the on chart patterns, and this started many years ago. So he created the pattern site in 2006. So we're talking 16 years, and you know, we're talking about thousands of patterns checked and verified. So for that reason, I would urge you to go and look at chart patterns if you're sort of skeptical about these working or not working, rather than having to sort of backtest them yourselves. So the symmetrical triangle, according to this, has a record that's not exactly stellar. So if you look at this, the overall performance for up or down breakouts, which is obviously what the triangle leads to by default, because price runs out of room and it has to break out. And the performance measured here is 36 out of 39 for the up breakout, and 34 out of 36. So not a very good performance. So the top performers are 1, and the bottom performers are in the 30s. Break-even failure 25 and 37 for up and down breakouts. You know, not a very good record. Now, the other thing I will say is that obviously the apex of the triangle is, or near the apex, about 3/4 of the way, is where the breakouts will happen usually, and with heavy breakout volume, that's where they perform better. And so it's quite usual to have throwbacks and pullbacks, and like in this example, you got a downward breakout and a pullback, and then basically the pattern is busted because it goes exactly in the opposite direction. So you got high volume here for the downward breakout, and then it reverses, and there's a higher volume still for going the opposite way. So in other words, what does that mean for us? Well, it means that we have this symmetrical triangle. We're nearly 3/4 of the way, and I said about 74% of the way to the apex is where it would usually occur. And then we would measure the top to bottom distance there. So we would measure this, I'll just make it a little bit smaller, and project it one way or the other. So if I used a ruler and essentially did measure this to here, that's 1.5% roughly. So you would take that from the breakout area. Let's say that you broke out here, 3/4 of the way it was an upward breakout, and we did whoops, we did the same, and 1.5% from here would take us exactly to here. Okay, just around to let's do it as, just need to make it a bit smaller because all the indicators below. Chart is going to run out of room. Okay, let's try it again. So, excuse me, 1.54. Okay, so it takes about here. You can't see, and that's 4215. Let's call it. Okay. So, and equally, if you went down, it would be downward breakout. What's that going to take us? Let's try it there. From here, and 1.54 take us to 4063. So back to the kind of 4000s. So that's kind of how we would project that breakouts, but again, a bit treacherous. The other thing I was going to show you, going back to this, is that we have an economic calendar of note next week. So that's the high-end kind of medium impact from my FX book economic calendar for the US. So we've got the Tuesday session, not much happening on a Monday. Tuesday session is going to be this data, but the Wednesday is going to be important. So Wednesday, put it on your calendar, on your diary, because it's going to be full of CPI, lots of that. Obviously, anything to do with inflation with the letter I, sort of I is the letter, and is the letter of the year, really, because inflation is the big concern, not just for the Fed, but obviously for everybody, really, whether it's businesses, individuals. And the core consumer price index is kind of very important, especially the core inflation. So looking at the numbers here, the consensus for core inflation year on year is 6.1. Previously was 5.9. Okay, consensus 6. So there's an expectation of it going up. In terms of the CPI, not the core inflation, but the actual inflation rate, consensus is that it's going down 8.7 from a previous of 9.1. Okay, so the consensus on the inflation rate as opposed to the core is that it's coming down. So slightly, slightly sort of mixed messages, because one is going up, expected to go up, and one is expected to go down. So again, how this is going to pan out is two ways. One, no change. Therefore, maybe expectation that the Fed doesn't have to try so hard, that it's working. But most people say it doesn't happen that fast. It takes a while for that to trickle down into the system, into the economy. So probably the inflation hasn't slowed down considerably enough for markets to think, oh, the Fed is going to slow down, etc. So it's all about the Fed again. Unfortunately, it's all about that. And then the Thursday, we have other important things as to do with the initial jobless claims and continuing jobless claims. So it's unemployment, again, very important. And the Michigan consumer sentiment, which ends the week next week. We had 52 consensus. We had 51.5 previously. So it's meant to pick up. Obviously, below 50, it's meant to be sort of contraction. So there we go. Whoops, lots of ads here. Sorry about that. So yeah, the core is 50 essentially, and if you go below that, it's generally meant to be a contraction in sentiment. So I'm going to just close these for a second. Now, one thing I was going to say about this is that I've gone to trading economics, and on that site I've sort of built this little chart, so to speak, basically overlaid two things. One is the consumer price index for the US, that's the blue line, so you can see for the last 25 years. And the other one is the federal funds rate, so essentially the central bank's interest rate. That is not a particularly revealing chart, and I'm not an economist, so I wouldn't like to speculate what it might mean or not in detail. But what really is clear is that inflation overall is sticky. So if you have a steep rise in inflation, it's unlikely to just go back through a central bank intervention. So essentially what we see in the black line there is the central bank interest rate, the Federal Reserve. And you can see that we had the pandemic kind of slowing down and backpedaling on interest rate, and then this year has been quite aggressive. As you can see, the steep rise there. Now it's trying to catch up with inflation. Obviously in 2008 we had a kind of slashing of the interest rate, and that obviously was a different scenario, but there was a steep rise in interest rates. If I do the max, so this is where it gets really interesting. Now we've heard about the mad inflation in the 1980s, and you see the interest rate there rising steeply and then coming down over time. So we are at historic lows. Doesn't mean to say that we have to go back to the rates of the 80s, but there's room to go. So it's not to say, and these markets are definitely overdone. So, but what that tells me as well, because as Aisha Tariq was saying, and others, that inflation is sticky, therefore it never really goes back to, doesn't mean to say that we're going to stay around 10% for the time being, but certainly prices are not necessarily going to go back very quickly to what they were. They will stick to a higher than we know now in terms of prices, and that's a consideration in terms of what it means, this kind of fight that the Fed has on its hands versus inflation, and how much it can really achieve. So, and it's something to bear in mind as well. But in terms of the sort of financial markets, what the Fed can achieve is a lot of cost to them. So it gets very difficult to fight the Fed. Remember, never fight the Fed. So this rally seems to be overdone for all these reasons, and just kind of trying to come back to that point. The other thing about technicals, going back to our lovely chart here, is I'll go to a daily just to really show what's going on here, and maybe just make it auto fit. There we go. So this is a daily for the E-mini S&P 500 futures, and you can see that the ATR 21 RMA, and that's the rolling moving average. You can see that it's really been declining a lot since June. So middle of June, we're nearly at the middle of August, not quite. So let's call it a couple of months anyway. And it's been declining to these levels, yeah, back here in April, sort of end of April. So we've had these strong moves around the middle of June, and then since then we've started declining ATR. So this up move's actually gone completely in divergence with average trading range. So smaller range going up. Also the RSI is going higher and higher. Now it's at 58 point something currently. So obviously it could do with being higher before we can call this an overbought market. And if you sort of look back, a real overbought would have been back here in November. And then we had a steep decline. But we are creeping up, so we are getting into overbought territory. Not quite fully, but if you look at the level that we're at now, it's the same level that we were at back here in March, end of March, when we had this big move down in the S&P. So all these things, the lack of average true range, so realized kind of volatility, in contrast with this kind of rally, so-called, which is kind of really stalled at these levels from May. Certainly it does make you wonder why this has happened, but certainly we are where we are, and all we can do is, and by the way, that's the tradingcode.net definition of the difference between the relative moving average RMA and the exponential moving average, because the ATR there on TradingView for the futures is set to RMA. So just wanted to show you this. That's the comparison. So and the EMA is more responsive to the most recent price than the RMA. So I just want to show you that. And to finish, we have obviously this situation where on the 4-hour we've had, as I was saying, we've had these higher highs, and we've got the CCI. Now I've highlighted that we had a divergence here in July, and that we had a divergence here at the end of July again. So twice it's happened, and then we've gone on to the 200 again, and this time round, and again we've had a divergence, then actually was followed by price. So finally, on the 4-hour at least, we've moved below the moving average and the weighted moving average, and we're sort of back below it. Although it's not a definite sort of victory for the bears, because as you can see, it's not really conclusive. So going back to the daily, that is where we are. We're still within the upper range of the 2 standard deviations for the Bollinger Bands. So still well above the basis, which is the 20 simple moving average and the 21 weighted moving average. So we still have room to go. But if this thing picks up, if volatility A picks up, so realized volatility ATR, daily range essentially, and also some kind of volume with the CPI next week, very important. Unfortunately, the weekend is upon us, so we don't have much room to really do much with this, but I do hope that next week we'll have some kind of conclusion and resolution of this through the CPI on Wednesday. So we really just have a weekend, then Monday, Tuesday to wait for, and the Wednesday. So I do hope and pray that we have some kind of resolution, because it's just been, I mean, logically and fundamentally, we are in a bear market. So let's just call it a downtrend. And, you know, trading it as a downtrend is much better in terms of, you know, targets and trending, etc. So this blip is actually disrupted trading that as one should in the direction of the trend intraday. So it would be good to see a resumption of that with some obviously volume and some kind of context where it feeds it at some kind of deeper move, and then it becomes better for trading and more profitable. So I am sorry for all bulls out there who really want this to work for them, being, you know, a bottom and sort of going up ever after. But I'm a bear, so to speak, although I'm into trade, intraday trading, but I think it's as a trade it works better at the moment overall, as the continuation of the downtrend being in place. So I hope this hasn't offended anybody. I will see you next week on Monday for our next video. Thanks so much for following me, and please like, share, subscribe and comment. Really appreciate it, and good luck trading out there, and take care.